5 chapters of work in 5 hours, where usually I spend double the amount of time to explain them. So what you're going to receive today is really the drop course. It's going to be the essentials, and it's going to be quick. So there will be some things that get left out that you're going to have to get from the book, or hopefully you've been going to lectures otherwise. But we're going to try and cover at least all of the main stuff over again. And for those of you who have been coming every week, this is your opportunity to clarify the things that have felt a little bit muddy so far. So if you have felt a little bit unsure of something, now is your time to ask it. And it's a good overview of kind of the whole course from beginning to end. So I usually start my semester with a review of 217 materials that are important. I'm not going to do that today, except to say that you will be required to do journal entries, most likely for your Chapter 2 question. You will be required to understand income statements and balance sheets. So if you're struggling with that, it's important to go back and kind of review your 217 material and at minimum know how to do journal entries. Understanding the basic accounting equation. All right, so let's start with Chapter 2, kind of looking at in general what we're doing in this class, okay? Chapter 1, by the way, read it. It shows up in MCQs, not a lot, but read it. Now, at the very foundation of this course, we're looking at cost accounting, how to categorize our costs and how to cost the objects that we make. So starting really foundationally, we need to look at all the money that we spend in our business and how it is that we categorize that. So, I'll move it to the center of the camera. So let's take all of our costs that we incur in running our business, okay? So this is absolutely everything that you spend. Now, the first kind of categorization or division that you want to understand is an accounting-based division, which is we separate all these costs into 2 major categories. One is product costs. Sometimes we call these the manufacturing costs. And the other is what we call period expenses. Sometimes we also call this selling and administrative expenses. So this is the first major division. Basically, this is saying we take everything that we spend, and depending on how we're spending it, it gets separated into 2 categories. Product or manufacturing is all of the costs that we spend making the thing that we make, whether that's a good or a service. So all the costs directly related to making something. Versus period expenses, which are all the other costs that we have that are not related to making the thing. So this includes administration, all of your kind of upper executive management, accounting, IT, marketing, sales. There's a lot of things that we have to do to run our business that isn't actually making the thing that we sell, okay? Now the reason why this division is important is because we treat these 2 types of costs fundamentally differently, okay? So first, let's look at how we deal with the product, how we deal with the product costs, and then we'll look at how we deal with the period costs. So, the costs that I expend to make something, they become the value of that thing that I make, right? So if I am making a pair of shoes, the money that I spend on the leather, on the thread, the glue, the dye, the whatever, all of that, along with the labor that I pay for people to make them, and all the associated overhead, become the value of that pair of shoes, right? I spent all this money to make this pair of shoes, and now those pair of shoes is worth that amount of money to me, right? So it's like I'm transforming that money that I spend into a thing, okay? So they become they become the value of the product made. It's like a nightmare, you know, you just want to check Facebook just a little bit and then one of the videos start to play. Okay. Whereas the exact opposite is my period expenses, okay? These are things where the money that I spend, I expense it in the period in which I spend it, okay? So I have my salaries for my admin. They work this month. I expense them this month. I spend money on paper, on all kinds of office supplies, on marketing, whatever, you know, I buy advertising, all this stuff. Those things don't become anything, right? These things just happen. And so they attach to the time in which they occur. Whereas these things attach to the item that I make or the product that I make. These attach to the time in which they occur. Okay? So expensed in the period in which they occur. Okay? And this makes sense when you think about it. My product costs, they become the product itself. And what do I do with things that I make? Where do I put them? Inventory, right? They hang out in my inventory. They become the things that I hold on to that are available to sell. Right? And inventory, this is an asset. Asset accounts live on my balance sheet. My balance sheet is like the tally of all the things that I own and all the things that I owe. Right? So these hang out here. When something is expensed, when it attaches to the time in which it is incurred, it goes through my income statement right away, right? My income statement is the report of my performance for a specific period, right? I have an income statement every month or every quarter or every year. Those expenses those costs which are expensed as period expenses, they go through my income statement right away, right? Sales minus cost of goods sold gives you gross profit, minus period expenses gives you NI, right? These are my period expenses right here. It's like a highway, they just go through. Okay? Now, these costs, hopefully one day will end up on your income statement. But they only end up on your income statement when you actually sell the items, right? I make the pair of shoes, but I own those pair of shoes that I made until the day that I sell them, right? So they're in my inventory and they belong to me, and they hang out on my balance sheet until the day that I sell them. The day that I sell them, that is when those shoes finally helped me generate revenue, right? So on the day when I sell them, they become cost of goods sold, which is an income statement element. That's when it goes through my income statement, when they're sold. Okay? So it's important to understand this big division. Okay? The other thing just to remind you is that, and this is the 217 thing, reminding you that inventory accounts, asset accounts, balance sheet accounts in general, these are what we call permanent accounts. Okay, permanent or real, sometimes they get called real accounts. They don't zero out at the end of every period, right? They exist throughout. Like my inventory, I don't zero it out at the end of the month because my inventory keeps lasting, right? Just because the end of the month is here doesn't mean that my inventory is worth $0. It remains, it still is worth that amount, you know, throughout the periods. Whereas income statement accounts, these are temporary accounts. And they zero out at the end of the period. Okay? They're like your odometer on your car. You take a trip, you zero out your odometer, you measure how far you go. At the end of the trip, you zero it out so that the next trip you take, you can count from zero, right? So at the end of every period, you zero out these accounts so that you know I made this much net income in this period. End of the period, zero it out so that the next period I'm starting from zero, I'm counting proper, right? Okay? So, in this course, we're mostly going to be dealing, especially pre-midterm, we're mostly dealing with our product and manufacturing costs, okay? So let's look at how we actually calculate these costs. Look, stuff that I wrote yesterday. Okay. So, one of the big tasks that we have in COM 305 is costing our units, okay? Costing our units is figuring out how much it cost us to make them. And the reason why this is so important is because we need to figure out, A, what to price our items, right? And we need to figure out whether or not we're making profit. And our profit is the difference between the price at which we sell something and the cost to us to make it, right? So, total cost of an item is equal to direct materials plus direct labor plus manufacturing overhead. Okay? So let's break this down and talk about what each of these things are. So, things that we make, they require physical materials to make them. Okay? Those physical materials, they usually come out of something that we call our raw materials inventory. Right? I make my shoes, so I have an inventory of leather and rubber and thread and all the things that I need to physically make the pair of shoes. Those things I buy and I keep them in a storeroom, a warehouse until the day that I use them. When I make my items, I take things out of the inventory and I move them onto the production room floor. Now, some of those items are going to be what we call direct materials, and some of them are going to be what we call indirect materials. And here's how we know the difference between them. Direct materials are those things which are easily traced and measured. Okay? I can observe with my eyes, I can measure quite relatively easily how much fabric I used to make this dress, right? I can observe it empirically and measure it. That is direct materials. Indirect materials are those things which are difficult to measure. Not impossible. Some people think that it means impossible to measure. They aren't necessarily impossible to measure. They are just difficult enough to measure that it's not worth it for you to measure it, right? It's like a cost-benefit analysis. When I make this table, let's assume that this table is made out of wood, which it's not, I can easily measure the amount of wood, right? But what about the exact amount of lacquer that I put on this table? Or how much sandpaper I use to sand this table versus the amount of sandpaper I use to sand that table? You know, if I put a ton of effort into it, I might be able to measure exactly how much sandpaper was used up to make this table versus that table. But it's quite difficult, and it's not worth it, right? It's not worth it for me to measure that. So the wood would be direct materials. I can easily trace it and measure it. But the sandpaper, that would be considered indirect materials. It's materials that I used up to make this table, but it's not easily traceable. It's not easily measurable, right? I can't look at this table after the fact and tell you how much sandpaper I used to make it, right? So, my direct materials, easily traced and measured. My indirect materials end up in MOH, okay? They end up joining the big pool that we call manufacturing overhead, which we'll deal with later, okay? Next is my direct labor. Direct labor, it kind of has a similar sort of definition. It's kind of a similar sort of thing, where how do I define between direct and indirect labor? My direct labor is labor that traces back directly to the object made, okay? These are people who actually touch the thing that you make, right? So these are people who cut the wood, who sand the wood, who assemble the table, who varnish it, right? These are all direct labor. They all touch the product. But then there's a whole batch of people who still work in my factory, but they don't touch every single unit that comes through. These are your custodial staff, the people who sweep the floors, the supervisors, the people who fix the machines, the people who do quality testing, right? People get confused with that one because quality testers do touch objects, but quality testers don't touch every single object, right? They only test a sample out of each batch. So they're not really direct labor, they're indirect labor, okay? So direct labor, they touch the objects. So out of your pool of factory labor, that which is direct, you measure it easily. That which is indirect pools in MOH. And that's the other thing. The reason why we separate these is because those who perform direct labor, I can easily measure how much time they're spending on the units, right? But because they're touching the objects, because they're working on the objects themselves, I can measure empirically how long they take to make this specific table. And I can do that through simple observation. But the person who supervises, right? They're supervising an entire room of people. How do I decide how much of that person's effort is spent on this specific unit versus that specific unit versus that specific unit? I can't empirically measure that because that person has no direct cause and effect relationship with any of the objects. Okay? So that brings us to manufacturing overhead. Now manufacturing overhead is like a problem child. It's kind of it's like a difficult thing to deal with, and we spend a lot of time on manufacturing overhead in this class. Because it's kind of like that drawer that you have at home that is a collection of all the things that have no other place, right? You open up the drawer and it's a hot mess. It's like all kinds of things like, pens and staples and who knows what's in there. It's like, you find kitchen utensils and I don't know what you keep in that drawer, but it's weird, okay? That's MOH. It's a bunch of things that don't necessarily have relation to each other, but they're all related to having produced your object. So in there, we already know two of the things in there, your indirect materials and your indirect labor. But you'll also have a batch of other things, like your rent, your utilities, your insurance, your depreciation, etc. It's like a lot of different things, okay? Basically, it's all the stuff, all the costs that you incur to make your objects that are not direct materials or direct labor. So it's a lot of things. And it's all gathered in one enormous pool called manufacturing overhead. Okay? And figuring out this guy is a whole other thing that we're going to deal with in like 20 minutes when we get to chapter 3. Okay? All right. So, now, a couple very important vocabulary things that you're going to need to understand to be able to answer questions on the exam. Number one, sometimes they're going to give you language like prime costs or conversion costs. Okay? Prime costs, if they say the prime costs of this object were $100, that means that that is the total of DM and DL together. Prime. Okay? If they tell you conversion costs were $500, they're saying that is the total of MOH and DL. That's that grouping. Okay? This is just an important vocabulary thing to remember. The other thing to remember is every once in a while on an exam, they are going to tempt you into doing this. And why is this absolutely the wrong thing to do? Because if you did that, you would be double counting your direct labor. Right? Direct labor is in both these categories. It's both a prime cost and a conversion cost. So if they give you your prime cost and they give you your conversion costs, if you were to add them together, you would be double counting your direct labor. Okay? So be careful. Every once in a while, they try and trick you somehow into doing this. All right? Okay. So we've talked about these kind of accounting definitions and this kind of accounting way of breaking down costs. But now I want to look at how we break down costs according to their behavior. So let's bring this guy back. And let's go back to all costs. All costs in my business, before we separated them based on what we did with them. Did we use them to make our product, or did we not use them to make our product? Now I want to separate them into two categories based on how they behave. Okay? So, costs are either variable or they are fixed. Okay? On the x-axis, this is how many units you make. Sometimes they use V to indicate it, sometimes they use Q. They're basically the same thing, your volume or your quantity. Okay? And let's say on the y-axis, this is your total cost. Variable costs behave like this. Whereas fixed costs behave like that. What does that mean? For my variable costs, if I make 1 unit versus if I make 10 units, my total will vary. But the variation will always kind of be at the same rate. My slope is at a fixed rate. Because every single unit has a stable cost per unit. Right? These variable costs are costs where we also call them incremental costs. Every additional unit will cost me that amount more. These are things like direct materials and direct labor, right? To make this dress, it takes me half a meter of fabric, okay? If I make one dress, it takes me half a meter. If I make another dress, it'll take me another half a meter. If I make another one, another half a meter. Every single dress is going to take a half a meter of fabric. For as many dresses as I want to make, every single one will take half a meter. So for every extra unit that I am making, I am increasing my total costs by the cost of a half a meter of fabric. Always ad infinitum, within my relevant range, right? The rule here that you should remember is that your per unit costs are stable. Your total cost varies with your Q or your V, whichever you prefer to call it. It basically means it varies according to how many units you make. If I make 1 unit, the cost for that unit is $5. Therefore, my total cost will be $5. If I make 10 units, each of them cost $5, my total cost will be $50. Every single unit has a stable per unit cost. Fixed costs operate in exactly the opposite manner. Okay? Fixed costs are those where the total cost is stable and per unit cost varies with your change in Q. Okay? So it's exactly the opposite. They're the flip side of each other. Okay? What does that mean? It means that this cost, no matter how many units I make, is going to stay exactly the same. So let's say that this is $1,000, right? My total cost for this fixed cost for the period is always going to be $1,000, no matter how many units I make. I like to explain this like rent, right? Your rent is what it is every month. It doesn't change. No matter how many nights you sleep in your apartment, your rent is always $1,000. If you go on vacation and you don't sleep in your apartment for half the month, that doesn't mean that you spend half the amount of rent, right? It's a fixed cost. It doesn't matter what you do with that fixed cost. The total stays as it is. So if I spend $1,000 on rent for my factory for the month, and in that month I'm able to make 100 units, or if I'm able to make 1,000 units, it doesn't matter how many units I make, my rent is always $1,000. But what changes is, if I were to say the per unit cost of rent, right? If I spend $1,000 on rent, and in that month I make 100 units, then that means that each unit cost me $10 in rent. Whereas if I had been able to make 1,000 units, then each unit would have only cost me $1 in rent. The more units I make, the more I'm dividing up that stable fixed cost. The lower the per unit cost becomes. Okay? So I always like to say and kind of instill in students that for variable costs, the kind of, it doesn't make sense, but it sticks in your brain, you know, like to say it's natural state, you know, everything has natural states. The natural state of variable costs is per unit. The natural state of fixed costs is as a total, right? If on the exam they give you a fixed cost per unit, I want you to kind of feel a bit nauseous, feel a bit nervous. Because you need to, in your mind, know that if they told you that the rent is $1 per unit, then you need to say, that makes me a bit nervous. Because I know that what they've just told me is only true at one specific Q. If I were to make even one more unit, then that unit cost would no longer be true, right? If they give you the fixed cost on a per unit level, and then they change the Q on you, if you were to use that unit cost, you'll get the wrong answer. So always if they give you a fixed cost in a per unit measurement, you should in your mind be very aware that if you're going to work with that information that they've given you, you should convert it at that Q into a total. Convert it back into the total, because then you can work with it. Then you can change your Q and figure out your new fixed cost per unit at the new Q. It's the same thing with a variable cost. If they told you that the total variable cost is $1 million, that is only true at one specific Q. If you make even one more unit, the total variable cost is going to change. So you need to be careful. If they give you total variable costs, you know that that is only true at one specific Q. If you want to work with that, if you want to be able to dial your Q up and down, you need to find your variable cost per unit. Okay? So, hope everyone got this. Now, sometimes you will have a situation where they give you a cost, which is what we call mixed. And it looks like this. Okay? This is a cost that has both a fixed element, right? Here's the fixed element. and a variable element. Why do we care about these? We care about these because manufacturing overhead is a mixed cost. That whole pool of manufacturing overhead is mixed. Because some of the things in manufacturing overhead, like indirect labor and indirect materials, those costs behave in a variable way. And some of those costs, like rent, behave in a fixed way. So sometimes you will have a mixed cost. And you will have to be able to pull this mixed cost apart somehow. This becomes particularly important after midterm, but they might throw this at you as well, okay? So really being able to do this, I mean, later on you're going to see that there are many different ways depending on what information they give you, but in chapter 2 they teach you one method, which is the high-low method. High-low method, if you remember your high school mathematics, is basically just one way of finding the slope of the line, right? So not the slope of the line, sorry, the equation of the line, right? This line, if we can find the equation y is equal to mx plus b, then we can be able to predict how much we're going to spend on this specific cost at any one particular level of production, okay, right? Y is your total cost, M is the slope of the line, so that would be your variable cost per unit, X is the number of units that you produce, and B is your intercept, which is your total fixed cost, okay? The high-low method basically says you pick a high point and a low point on the line, right? 2 points in the line. Usually how this happens in the question is they're going to give you like a chart where you will have, like let's say you're looking at the cost of running a company car, and they'll give you how many kilometers they drive and the associated cost of driving that car that many kilometers, right? So 100, 50, 75, 200, right? And they'll give you the associated cost. So I'm totally making these numbers up, okay? So your first step in this is to pick a high and a low. Pick your high and your low using your independent variable. So in this, which one is my independent variable? My kilometers or my dollars? Kilometers, right? The dollars are caused by the kilometers that I drive. The kilometers that I drive are not caused by the dollars that I spend, right? So my high is my 200, and my low is my 50. Okay? So the first thing that I'm going to do once I pick out my high and my low is I'm essentially going to find the slope of the line. To find the slope of the line, it's exactly as we did in high school. It's rise over run, right? Rise is how much does it change in this direction over run. How much does it change in this direction? Okay? So the change in the money over the change in the kilometers. So 625 minus 300 over 200 minus 50. Someone want to plug that into a calculator? You should all have a calculator. I know that this is theory, but still the same. Help me out. Let's just say 2.17, okay, just for the sake of illustration. This is, what is this? This 2.7 is what?
Slope.
It's the slope slope, but if I were to say 2.7 what? Is it like ferrets? Is it cars? What is it? What is this thing? Dollars per kilometer. Right? This is my slope. Okay? So now that I know my slope, right, 2.17, I can find my intercept. To find my intercept, I'm going to, at one of these two levels, I'm going to calculate how much of the total cost is due to the variable portion. Because if I take a look, let's say at 200 kilometers. At 200 kilometers, I'm spending a total of $625. A certain portion of that is due to variable cost. And another portion of it is due to fixed cost. Now that I have the fixed cost per unit, I can figure out how much at 200 kilometers of the total is related to variable. And I do it like this. If I drive 200 kilometers and each kilometer costs me $2.17, then I will spend a total of how much variable cost? $434. I will spend $434 on the variable portion. That's this. To find out the fixed portion, I just have to take the total minus the variable portion will give me the fixed portion. So the total, 625 minus 434, gives me, I do no math.
191.
191. This is my total fixed. That is my intercept. I know that my drawing is completely not to scale. Okay? Simple. Anyone have any questions about this? All right. The last thing for chapter 2, and sort of the one thing that they may test you long answer, is making a cost of goods manufactured schedule and or a portion of an income statement. The kind of sales minus cost of goods sold gives you your gross profit portion. So I know that in the old book, trying to find, where was it? I think it was on page 39 in the old version. In the new version of the textbook, I think it's on page 40 and 41. On those pages, you're going to find templates for those two things. Put a sticky note, take a look at them. You have to know that template of how to do a cost of goods manufactured schedule and how to do an income statement with the kind of alteration of cost of goods sold. There's like a little adaptation for calculating your cost of goods sold. All right? So you need to know those. So I'm going to go over that. You know what?
For those statements, do we need to write the proper heading?
Write the proper heading. Honestly, here's the thing with all of those. And in 217, in 305, and if you're an accounting student from now until the day that you retire or die or whatever, whenever you do tests for these things, the proper format, it doesn't give you extra points, right? There's no points associated to them, but if you don't do them, you might have points taken away. It's like you have a chance to lose, but no chance to gain, so just do it. It takes you 2 extra seconds. If they give you the company, if they go to the distance of giving you the company name, then they want you to make the heading, you know what I mean? So company name, the name of the statement that you're producing, and the date.
And what about abbreviations?
Ooh, abbreviations.
Are they no?
Yeah, abbreviations is a contentious issue. Like, I heard a story from one of the markers that, someone once did a 305 exam, and all of his numbers, he did like 10K, 15K, whatever, and he got everything wrong. He failed his exam because he didn't write out the proper numbers. Because this is not the answer, right? So write out your full numbers, right?
More for like the accounts and everything, like when you're doing it.
Yeah, but even the accounts, like, take the moment to do it. You know what I mean? Like, every once in a while, like if you're doing scratch calculations, abbreviating is okay for scratch calculations. Cost of goods, COGS and whatever. For scratch calculations, no problem. If you're doing formal statements, take the time to just write the word. Write the word for formal statements, write the word out for journal entries. But scratch calculations, you can make abbreviations, but here's the thing, like, if you've come up with a ton of different abbreviations that are like only for you, like your own personal language, then you might as well be writing your exam in wingdings. Like, they will not know what you are talking about. You have to remember that the people who are marking your exams, they're trying to give you points. But if they cannot understand what you are trying to communicate to them, they can give you nothing. Like, I know lots of people who mark exams and they are trying to make you pass this exam. But if your exam is illegible or you have written everything in abbreviations that only make sense to you, then you're really disadvantaging yourself.
What about your working process? Can you write with?
Oh, yeah. I mean, for the formal statement, write out work in process. For your scratch calculations, WIP is totally acceptable, right? I'm just, it's like a very, very small little bit of extra time, but if you're doing journal entries or a formal statement, write out the words. Because why? For the fraction of a second that you gain, why risk potentially losing the point if your grader is having a bad day? Do you know what I mean? Like, so just be cautious. And writing exams is a skill. There are certain things that you need to kind of learn and get. This is the other thing, like, take up as much space as you want in your exam booklet, right? Like, some people, they make these statements, and they'll be making the statement, then they'll be writing little things in the corner, and then there are arrows, and then they're like, check this out, and then a little tiny note right here, and like, use more pages, ask for extra booklets. Like, don't make this a horrifying experience for the person who is grading your exam, okay? So for the cost of goods manufactured schedule, I will do, tomorrow night I'm going to do an example. It's the kind of thing where it's best explained by doing an example from an exam. But what I can tell you is that essentially the cost of goods manufactured schedule is the schedule where you calculate total cost of what it is that you produce, right? It is your DM plus DL plus MOH, okay? And the important thing to understand about it is that when you run a company, you're constantly working, which means that in any particular period, you don't necessarily complete things 100%, right? We cut up time into, we cut up our year into quarters and into months for reporting purposes, but for you actually making this table or this dress or whatever it is that you make, you're not necessarily every single month that you report going to be starting from zero and finishing everything you make, correct? You might be working on something, and at the end of the month, you're still working on it. It isn't finished yet. So the month ends, 5 o'clock on the 31st, that month ends, and the table that you're making is only partially done. But on that day, you make your statement of cost of goods manufactured. The very next day, you come in, and it's a new period, and you continue working on that table that is half finished, and you'll probably finish it that month. So then you have this object where part of it was done last month and part of it was done this month, okay? And that happens all the time. at any particular moment in time, when you call the end of the month, you're going to have a bunch of units that aren't finished. And we call that work in process. Okay? Work in process, they kind of, they have 1 foot in the last period, 1 foot in this period. Now this guy becomes complex when I'm trying to calculate my total cost. Because my total cost for this month should be my direct materials plus my direct labor plus my MOH. But what about those units where some of them, I worked on some of it last month, some of it this month. Well, it's hard to figure out, right? So the tool that we use, and this kind of harkens back to 217, if you remember the calculation for figuring out cost of goods sold, it was your beginning inventory plus your purchases gives you available for sale minus your ending inventory gives you your cost of goods sold. This general calculation is extremely useful in this course. In 217, you only had one inventory. You just had your inventory. You were a merchandiser, right? You were a company where you bought things from one person and you sold them to another. But in 305, you're making things. You have many inventories. You have your raw materials inventory, your work in processes in inventory, you have your finished goods inventory, right? This calculation can be used to figure out the movement from any of those inventories into the next. My raw materials, when I move them into manufacturing, go into my WIP. When I finish my units, they go into finished goods. When I sell them, they go into cost of goods sold. Right? This calculation can be used to figure out any of these arrows. How much leaves an inventory and goes into the next thing.
So for cost of goods sold, isn't it beginning finished goods inventory?
Exactly. So you it's kind of like understand the underlying thing that's going on rather than memorizing the words on the board.
No.
You basically are just taking the beginning inventory of anything. Instead of thinking purchases, just think what you add to the inventory that month or that period gives you available minus your ending gives you what came out of the inventory that month. My beginning raw materials inventory plus what I add to it that month. What do I add to my raw materials inventory? How do I put things into my raw materials inventory? What do I do? I purchase, right? So raw materials inventory plus purchases gives me available for use, minus my ending raw materials inventory gives me what comes out of my raw materials inventory, right? So there's one issue about what comes out of my raw materials inventory, and what is that? My raw materials end up being one of two things, right? What are those two things? Direct materials or indirect materials. If they don't say anything in the question about indirect materials, you can safely make the assumption that everything that comes out of the raw materials inventory is direct and goes straight into WIP. If they give you an amount that is indirect materials, whatever you get that comes out of raw materials minus the indirect, the rest goes directly into WIP. The indirect goes into MOH. My work in process, right? This is how we figure out our cost of goods manufactured. I start with my beginning work in process, right? Those units that I didn't finish last month, but which are still on my factory floor at the first day of this month. I add to it all that I add to that inventory this period? What do I add to my WIP every period?
Total manufacturing,
Right, which are, break it down even more.
raw materials, direct labor, and then manufacturing.
DM, DL, MOH. I add DM, DL, MOH. Minus my ending WIP gives me my cost of goods manufactured. That's what this arrow is. Cost of goods manufactured are those things that go from my WIP into my finished goods this period. My finished goods, this is the calculation to find my cost of goods sold. My cost of goods sold is this arrow, that what comes out of my finished goods. Beginning finished goods inventory plus what I add to it this period. What do I add to finished goods? Cost of goods manufactured, exactly. Finished goods plus cost of goods manufactured gives me available for sale minus ending finished goods gives me cost of goods sold. Okay? So we'll do an example of a question like that tomorrow night, and that is chapter 2. Moving on to chapter 3. So chapter 3 is when we start looking at kind of the different ways, the different ways in which we make things and how that affects how we cost them. Okay? So pre-midterm, there are two kind of ways in which we make things that we look at. Chapter 3, we do job order costing, and chapter 4, we do process costing. Job order costing is when you make unique individual things. Every object you make is a snowflake, or every batch of objects that you make is an individual snowflake, and can only be made once you have your client specifications. Okay? So this is stuff like a tailor who makes custom clothes, right? That tailor can't make a suit for a client until the client comes in and picks the fabric and the style, and you measure that person to know exactly what to make. And then the suit is only for that client. You know, the client comes in and orders a wedding dress. You know, not every wedding dress is the same. They have to know what you want, what fabric you want, what size you are. It could be a printing company, right? So that's making individual objects. It could also be making batches of objects. Like a printing company, they might print magazines or wedding invitations or flyers for a party, right? They might make 500 flyers for a party, but they can't print a single one of them until you come in and you say, I want them to be this size and I want this kind of paper and here's my image that I want put on it, right? And then they'll make you an entire batch of those. All of those items are job order items because you can't make them until you know exactly what your client wants. This is in contrast to chapter 4, where we do process costing. Process costing is mass production. It's when you make many, many, many of exactly the same thing, right? It's your Pepsis, it's your Coca-Cola, your Nike, your Apple. Honestly, it's pretty much almost everything that you own. You know, we own very few things anymore that are, you know, custom, unique things. You know, and you might have a company where you make multiple kinds of things, like, you know, Coke makes Coke and Diet Coke and Coke Zero, and for a very brief period in the 90s, they made Coca-Cola Clear, which was a disaster, or whatever it was disgusting. But all of those are done with process costing, where you make many, many, many objects, and they're all exactly the same. So, let's look at chapter 3, sorry. Boom. Okay. So, if I have the kind of business where I make very unique objects, so I make custom furniture, and at any one moment in time, I have multiple jobs on the go, right? I have a workshop, I employ people, and they make custom furniture to client specifications. So I might have, you know, one job where I'm making a custom dining room set, and another job where I'm making a rocking chair, and another job where I'm making a, you know, like a cabinet, you know, another one where I'm making a dresser. So I have all these jobs on the go. And the problem for me is that every single job is unique. I'm spending money left and right, you know, direct materials, direct labor, the lights are on, you know, I'm paying rent, I have overhead. All this money is flying around. And I have these different jobs on the go, and they're all very different. The dining room set will not cost me the same amount to make as the rocking chair, or as the cabinet, or as the dresser. These are all different things that I'm making. They will take different quantities of materials. They will take different amounts of time to make. And proportionally, they should take up a different amount of overhead because of how different they all are. I can't just, you know, when my client comes to pick up the rocking chair, I can't just say, well, you know, I had 4 jobs on the go and I spent a total of $10,000 this month, so your rocking chair cost $2,500, right? Because the rocking chair really didn't take as much effort as, you know, the enormous dining room table with 6 chairs and a buffet. I have to make sure that I know exactly what I spent on that rocking chair versus the dining room table versus the dresser versus the cabinet. So the very important thing for chapter 3 is that you have to track what you spend on every single job precisely. So each job is given a number or some kind of ID, and you have to make sure that the flow of those objects as they travel into, you know, coming into being, that the money that you're spending, you're keeping track of it in lockstep. As that thing is, you know, someone works on that object for a couple hours, you're keeping track of that work. You're keeping track of exactly the materials going into that unit. Okay? So, very often this question usually is asked, there's 3 different ways that they ask it. They either do the T account question, they'll ask you to journalize all of the flow, so they'll ask the journal entry question, or the third, more dreaded kind is where they give you a bunch of information and ask you for balances in accounts and to cost jobs. That's usually the more complex kind, okay? For all of them, the key is understanding the flow of costs, okay? There's 4 million degrees in here. Okay, so let's look at how money flows in this process, okay? So when we start to make things, we take materials and labor and overhead and we put it into production. So let's look first at raw materials. Raw materials, I have a storehouse. I'm going to start making, I have a job to do. I go to the inventory person and I fill out what we call a requisition slip. And that gives me permission to take materials out of the raw materials inventory. That requisition slip will say what I'm taking and for what jobs. And I put that material into production. Stuff that comes out of my raw materials inventory, it has 2 possible places that it can go. What are those 2 possible places? Work in progress or manufacturing overhead. So, for that material which is direct, it can go directly to WIP. Because I know exactly for direct materials, I can empirically measure how much of it I'm using for which specific job. So I know right away that, I'm spending $500 on job number A20. But then I'm going to have some of my materials that are indirect. I take out sandpaper, I take out lacquer, I take out other things which it's not so easy for me to say how much goes into this specific table versus that table. For those things, they accumulate in manufacturing overhead. My journal entry will look like this. I'm moving value from raw materials inventory. Therefore, my raw materials inventory is going what? Up or down? It's going down. It's an asset account, so decreasing. Does it decrease on the left or the right?
Right.
Decreases on the right. Raw materials. So I credit raw materials, let's say that I'm 1,000. My debit side, it's going to go to two different places, MOH and WIP. I'm just going to give whatever value, let's say MOH, $200 goes there and $800 goes there. Okay? All right. The next is that I have factory labor. Labor, you need to understand how this works for physical flow, which is there is no inventory for labor, right? I can't keep hours worked in a storeroom. They just happen, and when they happen, I assign them right away. It's like a highway. It's in and out of that account. Okay? So, the physical flow is that my workers work and I pay them. So let's say that I have wages payable. Okay? And that wages payable for your factory workers accrues in an account that we call factory labor. If in the question they happen to say, your wages payable for the week was $10,000, of that amount, $10,000 was factory labor, $15,000, of that amount, $10,000 was factory labor. What they're essentially saying is that the other $5,000, the other $5,000, I have two kinds of labor, right? I have two kinds of workers. I'm either working in the factory, making my products, or I have people doing what? I have people doing sales and administrations type things. So that's sales and administrative. What do I do with those? These costs, see, my costs for my factory, they're going to end up becoming the value of my product. But how do I treat period expenses? I just gave you the answer. Yeah. You expense it right away, right? So you could call it sales and admin wages expense. Right? Two kinds of labor. Product labor is going to end up being the value of the product. Labor for sales and administrative tasks, that's an expense. This goes on my income statement right away. So now that I have value in my factory labor, I'm going to assign this. My factory labor can be two different kinds of labor. What are those two different kinds of labor? I love how you whisper so sweetly to me with the answers. Thank you. So direct and indirect. My direct labor that I can, my direct labor is easy to assign to specific jobs, right? If I'm a worker who works on the factory floor, I work for an hour on this table, right? On my timesheet, I'm like, worked an hour, job A20. Worked 2 hours on job A22. Worked 5 hours on job A23. I can measure it and tell you exactly what I worked on. So I can assign those people's labor directly to exactly the jobs. The problem is the labor for people like my supervisors or my janitors. They never touched any of the jobs. I still have to, those costs are still related to making the table. The person who comes in and cleans up at the end of the night and the person who supervises, they're essential to getting this table made. But I don't know exactly how much they spent on each and every job because they didn't touch any jobs, right? So they end up pooled in manufacturing overhead, and then I'm going to deal with that problem later. So the journal entry, I decrease my factory labor. And I assign it to either WIP for my direct or to MOH for my indirect. Okay? So now we come to the problem of manufacturing overhead. So we've been accumulating costs, and for those that are direct, we were able to pretty much accumulate them and assign them right away, right? The accumulation stage and the assigning stage were pretty much happening at the same time because it was easy, they were direct. But MOH, we have this problem where we're accumulating all these costs like crazy, right? MOH is one of our, generally, like, it's a big cost for us. It's a lot of things. Indirect labor and materials, rent, insurance, taxes, depreciation. But now we have to figure out how much of it to assign to each and every single job. Because let's take imagine I'm telling you, if you can, accounting seems really dry and boring and a lot of memorization, especially to people who didn't choose this as a major. But it's not dry if you just try and think of what it's actually doing. Accountancy is just, it's kind of like recording a story in code, okay? Every journal entry is recording something that is taking place in your business. So if you understand the narrative of what is happening, then you are going to do way better in this exam than just trying to memorize what I'm writing down on the board. My WIP is what's going on my factory floor. It is the value of all the jobs that people are working on. Every object, all the people, all the labor, it all has value. It's all money that's circulating on my factory floor. As I finish my units, I know that they have to leave my WIP and go to finished goods at their total value. They need to be costed DM plus DL plus MOH. So inside this WIP is a control account. It's my general ledger. My total WIP, when I say my total WIP is $100,000, that means that that's the total of everything that's happening on my factory floor if I add everything up. Within that general ledger, I have like sub-ledgers where I'm keeping track of everything that's happening in that WIP account. I can see that inside WIP, I have job A20, and it has this much DM and this much DL. I have job A21, and it has this much DM and this much DL. I have job A22, and it has this much DM and this much DL. It's all accumulating. As I'm assigning it, I'm keeping track of exactly how much of this 7,000 goes to each particular job. Okay? At the end of every month, the end of every period, whatever's left in my WIP, whatever DM and DL is accumulated for each of those jobs, I also have to apply overhead to them. When units leave my WIP, I know their DM and their DL, I'm going to have to apply the appropriate amount of MOH to give it its total cost to move it to finished goods. Okay? And why am I applying it instead of assigning it? I'm applying it because there is no direct connection between the things that accumulate in my MOH and the objects that exist in my WIP. Right? The rent that I pay, it does support the making of these objects, but it has no direct measurable connection that I could easily just look at this table and say how much rent it took up. Right? There's no direct connection, and that's a problem for me, because without the direct connection, how do I measure how much MOH that table gets? So we come up with systems to apply MOH. And the one that you need to learn for chapter 3 is called normal costing. Sometimes we call it using a predetermined rate. So we need to come up with some system for applying overhead to each unit. And I need this system to be proportional, to be reflective. Because the rocking chair should not get an equal amount of overhead to the dining room table or to the cabinet, right? It should get an amount that is appropriate to the resources and effort that I put into that job specifically versus this job versus that job. So we need a system that applies it proportional to some kind of measure of how much resources and effort each job took up. And the other problem is that we need it to happen in a timely manner. Because remember, my MOH is a collection of a bunch of different costs, like rent and taxes and insurance. My indirect materials, my indirect labor, those things are accumulating relatively every day. But my rent, I'm only paying that every month. My taxes, I might pay it quarterly or just at the end of the year. You know, my utilities, anyone who rents their own apartment or pays their own utilities knows that when you're trying, especially in Quebec where the winter gets so expensive, you try to predict how much you're going to spend on your winter utilities, but you don't know, right? You always open that like February hydro bill with like a lot of fear in your heart, you know what I mean? Because you took a guess. You know, you turn the heat down, you wear socks, you put 4 blankets on your bed, and you hope that it's not $1,000 at the end of February. So there's some costs that show up in your MOH only a few times a year. But you're making objects and selling objects all year long. And this table that I sell in January, it needs to bear some of the load of my taxes and my utilities, the cost of which I don't know yet, because I haven't received those bills yet. I don't know how much I spent on utilities, because I only get the bill next month. But I made this table today and I need to sell it today, so I need to know, I need to guess at what its cost is today, so that I can price it and sell it and move on with my life. Okay? So this is the problem of MOH. We have a timing problem and we have a measurement problem. So normal costing tries to, I don't know, it's kind of like a Band-Aid. It sort of deals with the problem, but not really. So there are three kind of major phases, three things that happen. Beginning of the year, throughout the year, and at the end of the year. So at the beginning of the year, when we're making our budget, we're going to come up with our predetermined rate. And how we do that is we estimate the total manufacturing overhead that we believe we will incur this year. We take a guess. We take a very good guess because we're smart people, and we look at our past year's performance and we look at projections, and we consult some psychics and we take a guess. So I say to myself, this is the total that I think I'm going to spend, all year. These are going to be my costs. Now I need to figure out how I'm going to divide these up and apply them to my objects. And how I'm going to do that is I'm going to pick what we call an activity base. And my activity base is going to be my bridge between MOH and WIP. There is no connection, so I'm going to piggyback it on some other connection that does exist. I'm going to borrow a connection. I'm going to use it as a bridge. Okay? My activity base has to be something that does have a direct connection to every single unit that I make. And it has to provide some measure relative to every other object of how much resources and effort I'm putting into this one thing. I need something that tells me how much I put into the rocking chair versus the table versus the cabinet. It needs to give me some measure of what is the relationship between these different things. Proportionally, how much should I give to each one? In general, on your exams, it'll be one of really two things. It's either going to be direct labor or it's going to be machine hours. And the labor will either be measured in hours, direct labor hours, or in cost, in dollars, direct labor costs. Okay? Direct labor hours and direct labor costs are exactly the same thing, except one is in hours and one is in dollars. So machine hours or direct labor, the idea is that those things provide a measure of how much each object consumes relative to another. If I want to say, I need to know how much overhead I need to give to the rocking chair versus the dining room set. If I say, well, the rocking chair took me 3 hours to make and the dining room set took me 20 hours to make, I can use that to tell me proportionally how much overhead each of those things should get relative to one another. So, once I pick my activity base, I estimate my total use of activity base for the year. So, total MOH, I think I'm going to incur over the total activity base I think I'm going to use during the year. Gives me my rate. My rate will either be dollars per direct labor hour, dollars per machine hour, or if your activity base is direct labor cost, it will come out as a percentage, right? Because it'll come out as dollar for dollar, which is a percent. Once I have this rate, I am going to use this rate throughout the year to apply my overhead one job at a time. Every single job that's in my WIP, at the end of the month, I assign it its overhead. Every single job that I finish and move from WIP into finished goods, I assign it its overhead using my rate. So I look at job number A20 and I say, okay, I spent $100 on direct materials, on direct labor, I spent $200. My MOH, I need to apply it. These things, I know from observation, they're direct. My MOH, I'm going to apply it. And how I apply it is I multiply how much this unit used of the activity base multiplied by the rate. Let's assume that the rate that came out was $5 per direct labor hour. And they tell you that you spent 20 direct labor hours. You would do 20 multiplied by 5. You would therefore apply $100. And your total cost of that item would be $400. If your rate was a percentage, if they had said that your rate was 50%, then how you do that? 50% of direct labor cost. My direct labor cost is $200 multiplied by 50%, gives me $100. I do that for every single job throughout the year. Okay? That's my applying. Now here's the problem with this system, and it shows up at the end of the year, or at the end of the period. They might get you to do this adjustment at the end of a month or whatever. So at the end of the period, the end of the year, the end of the month, whatever, you are going to have two numbers, okay? You are going to have the MOH that you actually incurred. This is going to be a real number, and you're going to have the MOH that you applied. Unless you were a total psychic or the luckiest person in the world, these two numbers are not going to equal each other. Because you have been applying your overhead all year long based on a guess. This is a guess, this is a guess, therefore this is a guess. It's a good guess, hopefully, but it's a guess. Right? And it's a guess that's kind of, from the beginning of the year to the end of the year, the chance of you hitting it right on the nose is like trying to hit a bullseye from a mile away. It's very unlikely that that these numbers are going to equal each other. Because all year long, in your T account, right? Your T account on the left side is your money, your costs being incurred going into your MOH account, right? So all year long, you are actually having costs come up, and you're paying them. So you're incurring costs, and all year long you are applying overhead based on your rate. So money is coming into the account based on actual costs to you, and you are taking money out of this account by applying it to jobs using your rate. Okay? So money going out of the account, money coming into the account. At the end of the year, you're going to compare these two numbers. And one will be larger than the other. In this case, I incurred more than I applied. Or you could think of it as I applied less than I incurred. What situation is this? Is this over or under applied overhead? It is under applied. My applied is less than my incurred, therefore I under applied. Under applied means I did not apply enough. At the end of the year, the period, I have to balance this account. This account needs to zero out. All of the overhead I incurred needs to be applied. And it needs to, and I can't over apply it, I can't apply too much. I need this account to zero out. So if I have not applied enough, right? I've not applied enough by how much? 15,000. I've underapplied by 15,000. It's as if this 15,000 is still left in this account. If I didn't apply enough, what is my solution? Apply some more, right? I need to get this money out of this account. If I have money left in the account, I need to get it out. I didn't apply enough, apply more. Apply it until it equals what you incurred. So my solution here is to apply more overhead, get this overhead out of the account. If I had had the opposite situation, where at the end of the year, I had right, this is my incurred, this is my applied. If I had had this situation, then I will have applied 47 but only incurred 40. I took more out of the account than what was put into the account. I have a $7,000 credit balance, which is the same thing as saying this account is like negative 7,000. It's $7,000 overdrawn. I put $40,000 into my bank account, but I wrote a check for $47,000. And my bank account went into overdraft. It went into a negative. How do I solve that problem?
So you over-applied.
I over-applied this overhead. How do I solve over-application? If I put $40,000 into my bank account but then write a check for 47 and it goes into overdraft and the bank calls me and says, you're $7,000 into your overdraft, what do you do?
Deposit the difference?
Pardon?
Deposit the difference?
I deposit the difference. I go to the bank account and I put $7,000 in my bank account, right? So if this MOH has a credit balance of 7,000, I took 7,000 out more than what was put in, so it's a negative 7,000. My solution is to put $7,000 back into the account so that it zeroes out. The same way that my solution here is to take $15,000 out of the account so that it zeroes out. It's balancing the accounts.
In the example you gave, you have to do
do a statement, you need to, where's the example you did, so you have to remove that amount?
So on the first one, we have underapplied overhead, right? My underapplied, I know what you're saying, because you're looking at the income statements, right? And you're getting confused because then it's like less and more and whatever. I'm gonna get there, okay? I promise. So let's look at the two methods of doing this. So we know that in this case, I need to take money out of this account. And in this case, I need to put money back in. Okay? Either way, the two methods tell you where you're either putting that money or taking that money out of. Okay? The first and simpler method is the COGS method. This method, you adjust the entire over under applied to one singular account, which is cost of goods sold. So in the case of the under applied, right? Under applied overhead, my solution is to apply more. If I apply more, that's like getting money out of the account. So if I need to move money out of MOH, I'm going to move it into cost of goods sold. My journal entry, if I'm taking money out of MOH is going down. Is that a debit or a credit?
It's a credit.
It's a credit. Okay? Here's the thing. If you're not an accountant, debit, credit, whatever, okay? Left and right. Left and right. If you're an accounting student, debit, credit, okay? Get really used to debit, credit. And this is going to sound really ridiculous, but this is the dumb stuff that, like, honestly, I do it to this day, and it helps me, because I really do get confused between debit and credit. And so, you know, when you were a kid, did you have trouble with left and right? And then maybe somebody taught you to do this, so that you know, there's the L, that's your left, right? It's good, it works. Left. You know? It works for people who didn't know left and right. I use something similar for debit and credit, and I basically do this. This is my debit, this is my credit. I literally, when I'm up here asking you guys debit or credit, in my mind I'm imagining myself doing this, and then I can see this little hand with its little C, and I know that this is my credit and this is my debit. Debit and credit. I'm telling you, in your mind. It sounds ridiculous, and I can't believe they're recording it. And I really hope, like, when I get a job and start working for a big firm, that no one ever looks this up and sees that, you know, and then looks over at me at the desk and thinks that in my mind I'm like, terrible, terrifying idea. Right? We all have little mnemonic things. All right, so I need to get that $15,000 out of this account, and I'm going to put it into cost of goods sold. This is decreasing, this is increasing. To solve this problem, right, where I incurred 47, but I applied, I incurred 40, but I applied 47, I applied too much. I've already taken too much out of the account. I have to reverse the problem. I have to take that money out of COGS and put it back into MOH. Okay? The other method is called proration. Under the COGS method, I'm just ramming the difference into one account. I'm adjusting just against one account and I'm done with it. But proration is basically spreading out this adjustment across 3 accounts. Instead of just having it adjusted against 1, I'm going to adjust it against 3. It's like spreading out the hurt, okay? And the 3 accounts, if you have trouble remembering, are the 3 downstream accounts from cost of goods sold. From cost of goods sold. I had a request from somebody to do chapter, because we're up to chapter, we've done up to chapter 4 now, so we have what's left is chapter 5 and 6. Somebody asked if I could do chapter 6 before doing chapter 5, just because that's the lecture that they missed and they have to leave. So I'm going to do it slightly out of order and do chapter 6 first, and then I'm going to do the theory of chapter 5. Chapter 5, honestly, is going to take us like a half an hour. Chapter 6 is the longer one anyway, and hopefully, if all goes according to plan, we will be out of here early today. Which is especially good because I have an exam tomorrow morning. All right. So chapter 6. CVP, cost, volume, profit. Now, this chapter, people get a bit afraid of it because they say, oh my God, so many formulas to remember, and they don't give us a formula sheet. Oh, but it's not so many formulas because it's 5 applications, and 3 out of the 5 applications are essentially exactly the same thing. They all collapse into the same exact, very simple formula, just with slight adjustments. And I'm going to tell you right now, if you don't think about the formula, but think about the narrative of what's going on, then you don't need a formula sheet, because the math is just a reflection of the story, okay? So let's look at it that way. So, at the core of CVP analysis is contribution margin and understanding what contribution margin is. Okay? So, to understand contribution margin, we have to go back to our income statement. So, we calculate in accounting, we learned the income statement as sales minus cost of goods sold gives us our gross profit minus our period expenses gives us our net income. And this basically, like, we're doing a lot of fancy things in between here, but if you just look at it from a bird's eye view, all that we're doing is saying the sales, the money that we take in from our customers, minus the costs that we pay, gives us our net income, gives us what's left over, right? So the money we take from our clients minus everything we spend gives us our MI. So we can just reimagine this by recategorizing these costs. Here we've separated these costs the accounting way. Right? Remember, like, all the way back, like, 2-3 hours ago, when we talked about chapter 2, and I did all costs, and we separated it out to product costs and period expenses. Product costs, period expenses. And then I erased it and said, or we can think of it as dividing it by how these costs behave. Variable and fixed. And we can divide all of our costs, not based on what they are used for, these accounting categorizations, we can divide them based on their cost behaviors. So try to reimagine the income statement as sales minus variable costs gives you you what we call contribution margin. Minus fixed costs gives you your net income. These two things are equivalent. They start at the same place and they get you to the same place. What you take in from your customers minus everything you spend gives you your NI. It's the same thing, right? We've just divided the costs in two different ways. So it's important to remember that this variable cost and these fixed costs, it is all of them. And by that I mean period and product together. Same thing for the fixed costs, product and period together. All of my variable costs, all of my fixed costs, right? So this is a much more useful way to think about your income statement if we're gonna use it for CVP analysis. And particularly, contribution margin is important. So I always use CM to represent this, FC to represent this, and VC to represent this, okay? From now on, those are the abbreviations we use. So what is my contribution margin? If I were to explain it in a couple sentences, I would say my contribution margin is the money left over from my revenue available to pay down my fixed costs. Okay? And let's look at really what that means. So we're going to go back to variable and fixed. Think about, like we just talked about this today, so I don't have to go over it too deeply because it should be very fresh in your mind. But your variable costs are those where the cost per unit is stable, but the total cost varies according to how many units you've made. If I make 1 unit and my cost per unit is equal to $5, then my total cost is $5. If I make 10 units, my total cost is $50. But my cost per unit is always $5. Whereas my fixed costs, my total is always the same, is always stable, but my per unit cost changes depending on how many units I make. If I make 5 units, I spend $5,000. If I make 500 units, I spend $5,000. I'm always spending $5,000 no matter how many units I make. But it is my per unit cost that changes depending on how many units I make. So let's look at these variable costs. We also call these incremental costs, okay? Because I know that every single unit is going to cost this specific amount of variable cost, and it's always going to be the same, then for every single unit, I know exactly how much of my revenue is left over, always. If my price is, what is my price going to be? If my price is $14 and my variable cost is $5, then my CM is going to be 9. And that's going to be true for every single unit I sell. As long as my price doesn't change, as long as I don't change anything, I know forever, for all of my units that I sell, that I take in $14 and 5 of it will go to cover the variable cost of that specific unit, and $9 will be left over. No matter how many units I sell, I know that that is true for every single one of them. Because that is the nature of variable costs. The variable cost is always the same. If I'm currently producing 10 units, and I start to say, well, maybe I should start making 11 units, I know exactly how much that 11th unit is going to cost me in variable cost. It's going to cost me $5. It's always going to be that. Okay? And because of this always being stable on a per unit level, I always know that this CM is 9. And my contribution margin, my CM, is the money that then is available to start paying off this cost. Because even though these variable costs, I'm incurring them for each unit that I make another unit, I incur that extra cost. I make another unit, I incur that extra cost. Right? How much I spend on this depends on how many units I make. But this is just a big lump. No matter how many units I make, I have this big $5,000 lump to pay off. Okay? But I know that for every single unit that I produce and sell, I can chip away at this big lump $9 at a time. I sell one unit, $9. 4,991. Oh, I only have 4,991 left to go. I sell another unit, etc., etc. I'm selling little chunks. I'm eating away at that big chunk, and I'm slowly diminishing it. Okay? Chipping away at it very slowly, what I really need to know is how long is it going to take me before I get this guy down to 0. Because as long as I'm still chipping away at him, my business is operating at a loss. Okay? Because this is important to understand, right? Until I pay this off, my net income is less than 0. My costs exceed my revenue, right? If I'm only selling one unit, I've taken in $14, 5 went to VC, 9 left to CM, and $5,000 of fixed cost, my net income, right, is a negative. So until I can pay off that fixed cost, I'm feeling very nervous because my business is operating at a loss. And so this is our first application. Break-even point. Okay? And this is a really important number for me. It's a very important moment in my business. Because my break-even point is the point at which I have slowly, unit by unit, whittled down this fixed cost to nothing. The moment that I pay off my fixed cost, my net income is 0. Right? I have my revenue, I pay off my variable costs, I pay off my fixed costs, my net income is 0. We call that my break-even point. I neither make money, nor do I lose money. I'm even Steven. Okay? And this is a really, really important point in my business. Because even though at this moment I make $0, it's like the turning point in my company. Because the very next unit that I sell after my break-even point, I take in $9 from my client, 5 of them go to pay off the incremental cost of that extra unit that I just made, and I have $9 left over to pay off fixed costs, but guess what? I paid off all my fixed costs. So I have no more fixed costs to pay. That means that this entire $9 is net income. All $9 goes into my pocket, right? Because I've paid off all my costs. At that point, every unit, and this is really important, this kind of understanding the ramifications of this gets tested in problems all the time. Every unit that you sell after your break-even point, the contribution margin is 100% net income. 100% net income. Okay? So how do we calculate break-even point? The formula is very simple. The formula is fixed costs divided by my contribution margin gives me my break-even point in units. And this makes sense. And let me tell you how this, like, as soon as I tell this, you're going to be like, big thing. Think of it this way. My rent is $500. And I work at a job where I make $10 an hour. How many hours do I have to work to make my rent? 50, right? I have 5,000 fixed costs. And for every unit that I sell, I get $9 to pay off those fixed costs. How many units do I have to sell to pay off the fixed costs? It's exactly the same thing. My rent, how much I make an hour. How many hours do I have to work? My fixed costs I need to pay off, how much per unit I get to go towards paying it off, gives me how many units I have to sell. Someone want to pop that into a calculator? 555 point something or other? 56? If you have a situation where you get a decimal, show the decimal and then round it up. Because at 555, you have not hit your break-even point, you're still operating at a loss. But at 556, you're above the break-even point, but you have broken even. Show the decimal and round it up, okay? Let's pretend that this came out even and beautiful. We're like living in an alternate universe where I can bend space and time in simple mathematics. All right. So, this is to get the break-even point in units. They might ask you to get your break-even point in dollars. And I know that everyone always thinks, well, then I can just take the number of units and multiply it by the price, and then I have my dollars. And yes, you could do that. But that's not what they want you to do, okay? They want you to use a very tiny variation on this, which is fixed cost divided by what we call our CM ratio. And that'll give you your break-even point in dollars. What is your CM ratio? So the CM ratio is really simple. I really like visual tricks because they help me when I, like my little credits and debits and stuff. Bring my CM up, bring my price down. This gives me my CM ratio. If you want it as a formula, it is CM over sales. I can calculate this using either per unit, or I can calculate it using totals, right? If they tell me that my total sales are $140, that means that my total VC would be $50 and my total CM would be $90. 90 over 140 is going to give you the exact same percentage as 9 over 14. right? So although I can only calculate my CM per unit on a unit level, or if they give you your total CM, you can divide it by the number of units. Your CM ratio, you can calculate, because it's a ratio, right? It's a relationship. You can calculate it using it on a per unit level, or you can calculate it as totals. It should come out exactly the same. Because if I told you that there were 10 people out of 100 who did something, it's the same way as if I told you 1 out of 10. It's exactly the same thing. It's a ratio. That's the beauty of ratios, right? So what is this? 90 divided by 140 equals what?
0.6.
You guys are like the horse whisperer. You're like 64.
4.6.
Okay. So what does this ratio mean? If I were to explain to you in words, I would say that of my sales, 64% of them go towards paying off my fixed costs. 64% of them end up as contribution margin. I hate decimals. So it's like saying of every dollar of revenue that I take in, 64%, 64 cents goes towards paying off my fixed costs. And once my fixed costs are paid off, that 64 cents for every dollar goes straight into my pocket. Okay? Now, your CM ratio has an important relationship with your VC ratio, which is that the two added together equal 100%. So if my CM ratio is 64%, then my VC ratio must be 36%, because they have to add up to 100. Because my variable cost ratio is just saying of every dollar that I take in of revenue, 36% goes to pay off my variable cost, and 64% goes to pay off my fixed costs. Right? So if in the exam they give you your variable cost ratio, they have given you your CM ratio, because you know that these two have this relationship. And I know sometimes people look at questions and they're like, they didn't give me the information that I needed. But sometimes the information is right there. You just need to know how to find it, right? Okay? So, my break-even point in dollars then is $5,000 divided by 0.64. 7,812.5. I need revenues of $7,812 for my break-even point to be zero. Okay? Anyone have any questions about this? Go for it.
You said, if they give the VC ratio in the test, what, like,
If they tell you that your variable cost ratio is 30%, then you know that your CM ratio has to be 70%.
okay.
So it's like they're just giving you its opposite, right? Any other questions? Beautiful. That's the first application, break-even point. The next application is really, it's still break-even point, it's just break-even point with a twist. So it's still the same formula, and this application is called target income. So for break-even point, you basically ask yourself, how many units do I have to sell for my net income to equal 0? That's what you were asking, right? Now you're simply saying, how many units do I have to sell for my net income to equal, and you choose a point. I want it to equal $10,000. I want it to equal $20,000. How many units do I have to sell for it to equal, for my net income to equal that amount? And it is exactly the same thing. You're just changing where you're aiming. You use exactly the same tool. You've just moved the bullseye. Okay? Because before we were saying, how many units do I have to sell to cover my fixed cost? Now all that you're saying is, I want to cover my fixed cost, and I also want some profit. So how many units do I have to sell to not only cover my fixed cost, but also cover some kind of profit? Because remember, every single unit that you sell after your break-even point, all of it goes directly to covering net income. So, my fixed cost plus, I want to make $20,000. I want to make $22,000 of net income. I have to sell 3,000 units. If I sell 3,000 units, then, and somebody help me with this, what was my price was what, $14?
Yeah.
So I sell 3,000 units at $14 a piece. What is that? 42,000. Each of those 3,000 units cost me $5 in variable costs. Oh God, I hate do this for me.
27.
27. This is my contribution margin. My fixed cost is $5,000. My net income is $22,000. Because I'm essentially doing the same thing. I'm essentially still saying, I want to cover this amount of money, and I earn this amount of money per unit. It's the same exact question.
Like the 42,000 and the 22,000 is always going to be the same, right?
Mm-hmm. Yeah, because this is what I'm aiming for, right?
Why did you multiply those by 14 and then 5?
This is my price. So this is my sales,
Okay,
my sales revenue, and this is my total variable cost.
okay.
Go for it.
The reason we didn't do it like this for the break-even point is because they require us to use the CM ratio. Is that why?
No. You can do the same thing here. I can find it in dollars by doing 5,000 plus 22,000 divided by 0.64. Of course, it was 0.6428, so do it properly. It should come out to 42,000.
But for the break-even one, could I do it like this as well, or do I have to use
No. This, I'm just doing this to illustrate to you that it works.
Oh, okay.
I just want to show you that it works. If they ask you for the break-even point in dollars or the target income in dollars, do it with your CM ratio. If you do it the long way around, you're not going to get the points. They want to see that you know to do it with the ratio. But this, someone plug it into a calculator, it should equal 42,000. So $42,003? Okay. $42,003. Probably because this had like a much longer decimal. If you had kept, if my example that I came up with at the top of my head had no mathematical imperfections that I could foresee all the way down the line when I'm terrible at mental math, then it would be perfect.
So we use the decimal when they ask us for the dollars.
Yeah. When I want it in units, I divide it by CM in units. When I want it in dollars, I divide by the ratio. Any other questions on this? Okay. So the one complication that they might give you with target income is whether they're going to throw taxes at you. Okay? So we all know that in our company, when we make net income, the government is going to come and take a piece, right? So we have to pay taxes. And let's assume for this question that we live in a very generous country and our taxes are only 10%. Yeah, I know, eh? We're like very rich, our country, so we don't take taxes. We are the world's leading exporter of, I don't know, diamonds covered in gold. Like, our taxes are only 10%. So, in this, how taxes work is they take 10% of whatever your net income is. So, you can calculate this as 10% of 22,000 is 2,200. What is that? That's $19,800 left over. This is what we call our net income after tax. This is our net income before tax. So in this question, they might say, listen, how many units do I have to sell for me to get $19,800 in my pocket after the government takes its piece? How many units do I have to sell to have $19,800 of after-tax income? So, this formula, fixed cost plus target income, it works with the before-tax net income. So if they ask you to hit the after-tax net income, they're introducing a whole new variable, which is like outside the system. So you need to get back to this number in order to plug it into this equation. So if they ask you for the target, how many units you have to sell to make 19,800 after tax, they will have to provide you with the tax rate. They have to provide you with the tax rate. And you are going to use that tax rate, and you have to reverse the taxes. And reversing the taxes is really easy. People always get really confused, but here's how it goes. And you don't even need to remember the formula. Like the formula is you can, if you're really good at memorizing, memorize the formula, but just think of it this way. To calculate this net income after taxes, what did I do? I took the taxes and I multiplied it by the tax rate, and I got the taxes. Then I did net income minus taxes gives me net income after taxes. But I could have also calculated my net income after taxes like this. I have my net income before taxes of $22,000. If the tax rate is 10%, how much do I get to keep? 90, right? I get to keep 90%. 22,000 times 0.9 equals 19,800, right? It's the same thing. If I think of it like that, when you calculate it like this, it boggles your mind how to reverse it. But if you think of it like this, it's easy to reverse. Because if I take 22,000 multiplied by 0.9 gives me 19,800, then to go backwards, I just do 19,800 divided by 0.9 gives me 22,000. That's it. So just think of it that way. What do I get to keep? I get to keep 90%, then reverse it. So the formula is to get net income before taxes, you divide net income after taxes by 1 minus the tax rate. This is the formula that you can remember. Or you can just think of it this way. So if they ask you to hit the net income after taxes, reverse it to get the net income before taxes, and then just do your simple break-even point. That's it. But I'm going to tell you right now that you're going to look at so many exams, and you're going to see exams that say, how many units do I have to sell to make $10,000 before taxes? The income tax rate is 40%.
You don't need it.
Yeah, the tax rate that they gave me, they gave it to me for no reason. They gave it to you to make you sweat, right? Because what did they say? They said, I want to make $10,000 net income before taxes. They gave you this number. This is where they're, and then they give you the tax rate to mess with you, to try to get you to reverse the taxes. But there are no taxes to reverse. They want net income before taxes. So know in your mind that this is net income before taxes, and this is net income after taxes. If in the question they ask you for the target income before tax, then you're laughing. You have nothing to worry about. You only need to reverse taxes if what they're looking for is the after-tax net income. Okay? Does anyone have any questions about this?
You clear that up all the time. I didn't really-
How far do we have to dial it back?
Just that, not small.
The tax one?
Yeah, like the question they ask you.
Oh, because basically what they're saying is, they're trying to trick you, right? If they say, I want a target income of $5,000 before tax, then they're going to provide you the tax rate. They'll say tax rate is 30%. So they've given you the tax rate in the hope
You divide it.
that you're going to do this.
And they don't have to-
But the only reason why you would do this is to find net income before tax, but they gave you the net income before tax. You know what I mean? They're trying to trick you. Because a lot of people get confused about net income before tax and net income after tax, which is the one that I have to reverse. But if you ever get confused about things, in the margin of your paper, just put your income statement. Sales minus VC equals CM minus FC equals net income before I have to pay my taxes. Then I pay my taxes. That is my net income after I've paid my taxes. Right? Honestly, like, this is like using a sledgehammer to like put in a tiny little nail, but by any means necessary, right? Like one of my favorite quotes from Malcolm X. By any means necessary. If you have to use a whole page just to remember what this all is, do a whole page of scratch. If you need, when you're doing chapter 4, if you have to make a bunch of timelines and use highlighters and draw it out to figure out what you need, in your exam, do it. Write all over your exam. Erase 1,000,000 times. But use whatever tools that you need to remember and figure it out. Okay? Does anyone have any more questions about this one? Okay, so now the third application, which again is just a variation of break-even point, is sales mix. Okay? So, all along, we've been using a very simple model. We've been working with a company that has one product that they sell for $14, and it has $5 variable cost, and it has $9 CM. And that's it. Simple company that makes one thing. But the reality is that most companies make more than one thing, right? You have multiple product lines. Your multiple product lines put together, we call that your sales mix, right? So how do we do something like break-even point or target income when instead of one CM, you have multiple CMs because you have multiple products. And each of your products has a different sales price. Each of them has a different variable cost. All of them together share one fixed cost because they're all made by the same company, but they each have an individual CM. So, in order to the key to figuring this one out is what I like to call your WACM, your weighted average contribution margin. Okay? Weighted average contribution margin is just a tool for combining the CMs of all your different product lines into one CM. Why do we use a weighted average instead of a pure average? It is because not all of your product lines are necessarily of equal importance to you. Right? Apple sells a different amount of iPhones than they do iPods, than they do MacBook Airs, than they do MacBook Pros, than they do iMacs. Right? Each of those product lines is of a different size. Their sales are different for each of them. When you add them all together, that's 100% of all of Apple's sales, but each of their product lines represent a different percentage of the total. And because each of them represent a different percentage of the total, you can't take a pure average. Because you might have one product line that's more important. So it needs to take up more room in your average than a product line that's smaller. So let's look at how we calculate our WACM. So the first thing is you need to calculate your CM for each product line. So let's say that we have a company where we make cups and we make teapots. So they will have to give you a price and they'll have to give you a variable cost. They might be generous. I've seen some questions where in a sales mix they already give you the CM of each. Sometimes they're generous, sometimes they give you the tiny pieces, right? So let's say that each of my cups costs $5 and the VC is $2, so I make a CM of $3 off of each of them. And my teapots, my price is $10 and my variable cost is $6, and that means that my CM is $4 for each teapot. So the next thing I have to calculate is my weights. Okay? So weights is basically saying the relative importance of each of the lines, the percentage. The percentage that each makes up of the whole. And the weights are always calculated using sales. Okay? So let's say the number of units that I sell is that I sell 25,000 cups, but I only sell 10,000 teapots. So this is like proration when we did over under applied overhead. Calculating the weights is exactly the same thing. You find the total sales, and then you find out how much each represents of the total. Someone tell me these weights.
71.4.
Oh God, I'm inputting your numbers. 25,000 and 5,000 equals 30. I hate the decimals because they screw up everything down the line, you know what I mean? So 25,000 out of 30 and 5,000 out of 30. 83? Again. $20,000. 10, but then it's gonna be,
No, it's 50%. It's 50.
yeah, see, that's what I'm talking about. You know what, I'm killing it on teapots, I'm killing it on teapots, okay?
So
Forget it.
0.5.
Everyone loves teapots, you all get 10 teapots. So this is 20 out of 60 and 40 out of 60.
0.3.
Yeah.
Use 20 and 5.
Instead of
Yeah,
40.
20 and
What?
10,000.
45?
No, 20 and 5.
Maybe 10,000.
Teapots, but 5,000.
Maybe yeah, 10,000.
Okay, you all obviously know how to do the math now. This guy represents
20.
40% of the sales and this guy represents 60% of the sales, okay? You got me? When you do the math, it works out like this. Okay? You might get lucky also, they might just give you the weights. But you all understand how to do them. I just don't want decimals for my example. When you have decimals in the exam, keep as many decimal points after the period as possible. Never carry any less than like 3, 4 decimals at least. Like if it's a long decimal, always carry at least 3 or 4 until the very end. Only round off with your very last answer. Okay? So number 3 is you calculate your Wacom. And how you do that is, and this is straight up from statistics, right? It's the sum of your weights multiplied by your CM. So in this case, it's 0.4 times 3 plus 0.6 times 4.
Wait.
Okay, the decimal. 3.6? My weighted average contribution margin is $3.60. Now that I have this, I can use this to either do a target income or a break-even point. I use it exactly in the same way. So they can ask you to do a sales mix with a target income, or they can ask you a sales mix and a break-even point. Either one. They might say, how many units of each product line do I need to sell to break even? Or they would say, how many units of each product line do I need to sell to make $10,000, either before or after taxes? If they ask for the after tax, they have to provide you with the tax rate percentage.
So you use that as your CM.
Use that as your CM, it's the same thing. So let's say that it was to do a break-even point, and let's say that my fixed costs are $20,000. Break even.
5,555.555.
5,555. Ooh. Is that hockey? Okay. So, here is where we are in this question. They've asked you how many units of each.
Where's the 20?
I made it up.
Oh, okay.
This is my fixed cost. I don't own a business that sells teapots or cups. I made it all up. I lied to you the whole way
I just wanted
through.
to know, like, that was fixed cost.
So it's just fixed cost divided by my WACC.
This is a break.
This is a break-even point. But I could have just as easily said, the fixed costs are $20,000 and I want to make $10,000. Then you would just do 20,000 plus 10 divided by 360. It's the same thing. You can use sales mix with either target income or break-even point. Okay? But what they will always ask you is how many cups and how many teapots do I have to sell to break even? But what have I gotten here? I only have one number. This is the total of both teapots and cups together. I need to know how many teacups and how many teapots. The weights, exactly. I already know how to divide this number up. I know the sales mix. So just use your sales mix to pull this number apart. If my cups represent 40%, then 0.4 times 555.55 forever. Keep your decimal when you do this, only round it off at the very end. And 0.6 times 555. That's going to give you your cups, and this is going to give you your teapots. The numbers don't matter, as long as you understand what's going on. Okay? Does anyone have any questions about sales mix? Go for it.
Get how you go from that line to the sales.
What do you mean? This?
Yeah.
Well, they're going to give you, there's two things. Either they're going to be generous, like I've seen questions where they give you the CM straight up and they give you the weights straight up. They'll just give you the percentages. They're just testing that you know how to calculate the WACA, and the percentage times the CM, right? 40% times 3 plus 60% times 4. But if they give you this, if they just give you the sales, if I want to calculate the value of anything, right? If I tell you that there's 30 people on the side of this room and 20 people on this side of the room, and then I say, how much percent of the total class is sitting on the left versus how much percent of the total class is sitting on the right? How I do that is I add everything together to get the total, and then I do the number of people on this room divided by the total gives me the percent of this room, and the number of people on this side of the room divided by the total gives me the percent here. It's the same thing with sales. If I have 5 here, if I have 4 here and 6 here, they add up to 10. 4 over 10 equals 40%. 6 over 10 is equal to 60%. It's the same thing as proration. Oh, go for it.
Yeah, in some problems there is like instead of units there is baskets. What's the difference?
There is what?
Baskets like 3 to 1 or 4.
Are your units baskets? Like you sell baskets? I don't know what you're talking
Yeah,
about.
like many units in one basket, like many units from product 1 and many units from product 2 in one basket. Understand what I mean?
I think that I kind of need to see the question. Do you know what I, or do you know the question that she's talking about?
I know what she's talking about. It's just the way of thinking about what is like your WACM. You just consider it as like a collection of goods, and then in that basket it's how many baskets, it's that number that calculates the cups and the teapots.
Oh, you mean like it's a collection? Like you
Yeah.
say that I make teapots and I make cups and teapots, and I either sell them as 1 teapot and 6 cups, or 1
Yeah,
teapot and
exactly.
4 cups.
Yeah.
And those are my 2 products. So my actual products is either a set with 4 cups or a set with 6 cups. So those are my 2 products.
Yeah.
And then they ask you how many teacups and how many pots. So they're just, yeah, I get you, gotcha. Okay, so you basically would think of it like, because basically, and when they give you the contribution, they give you the price of the basket, right? The price of the basket, the contribution margin of the basket. So basically then, you would have like your group 1 or your basket 1 and your group 2 or your basket 2, and they're groups of products. So you do the same thing and get your Wacom for group 1 plus group 2.
Okay.
And when you get to this point, you know how many of group 1 and how many of group 2. And you know that in group 1, you have 1 teapot and 4 cups. And you know in group 2, you have 1 teapot and 6 cups.
Okay.
So you would then just say, however many in here equals how many, times 1 equals how many teapots. This times 1 equals how many teapots, how many total teapots. Right, you know what I'm saying?
Yeah, yeah.
So you just kind of do the whole thing for the basket, and then at the end, undo the baskets and see what's in them.
Okay.
What am I doing? Okay, gotcha. Oh, go.
Just one, what was that last step there where you went 4 times 5?
This, because when I get my break-even point here, this is my total. This is the total units of everything. This is teacups and teapots together. But I want to know how many teacups specifically and how many teapots specifically. So I have to undo this number. And I use my weights to undo them. Because I know that if this is the total number of sales, I know that 40% of it is going to be cups and 60% of it is going to be pots.
Yeah, thank you.
Anyone else? Okay. So that's 3 out of the 5 applications, and all of them basically use break-even point. Okay? All of them use this basic idea. So we have 2 others. All right. So first of all, we have got margin of safety. Margin of safety is pretty simple. Formula is sales minus your break-even point. Right, this will be in dollars, this will be in dollars, gives you your margin of safety in dollars. You will also sometimes be asked to transform your margin of safety into a ratio. And you do it the same way that you transformed your contribution margin into a contribution margin ratio. So, margin of safety over sales. This will give you your margin of safety as a percentage. So this is the formula. What does it mean? So I've got a company, and we sell $1 million. Let's actually say, because you can use either projected or real numbers, so it can either be projected sales, projected whatever, or it can be actuals. So let's say that someone comes to me to invest in 2 different projects. Okay, I'm like a investor. I have a lot of money and nothing to do. Okay, and so project 1, they project that their sales are going to be $1 million, and they say that for this project, their break-even point is $600,000. This is their margin of safety, which is equal to $400,000. The amount from the sales to the break-even point. It is the amount in dollars that my sales can drop before I start operating at a loss. If my sales drop below 600,000, then my net income will go below 0. I'll start losing money. I'll be operating in the red. If my sales drop below 600,000, I won't be able to pay off all my fixed costs. So this is like my cushion. And my margin of safety as my cushion is a measure of risk. Do I want my cushion to be small or do I want it to be big? I want it to be big, right? If you jump off a building and into one of those big, like, inflatable things that stunt people have to jump into, do you want it to be a little bitty thing or do you want it to be like massive? You want it to be huge, right? Now, margin of safety in dollars is somewhat useful, but margin of safety translated into percentage is infinitely more useful because what if I'm considering two different projects to invest in, and my other project, the sales that they project is $1 billion. And their break-even point is 800 million. 800 million. Took a minute, like zeroing. So here is my margin of safety. And it's equal to 200 million. If I'm comparing these companies using margin of safety in dollars, obviously this one has a much larger margin of safety. It has $200 million of cushion, whereas this guy only has 400,000, right? This guy's sales can drop by $200 million before they start operating at a loss. But the problem is that I'm comparing two things of very different scale. So comparing them dollar to dollar is not fair. It's not actually telling me that this is less risky than this. Even though this margin of safety is so much larger than this margin of safety when measured in dollars, when we translate it into percentage, it's going to tell the real story, which is 200 million divided by 1 billion is what? 20%, right? But 400,000 divided by 1 million is 40%. So what's actually happening here is that for project A, sales could drop by 40% before they start operating at a loss. And for project B, sales can only drop by 20% before they start operating at a loss. So when you put them on the same scale, you see that project A is actually a lot safer than project B. Okay?
At the break-even point, is that for the sales mix only, or it could be like individual product?
Doesn't matter. Just the break-even. Yeah, I mean, if the company only has one product, then it's just for one product. If it would be sales mix, if they have multiple products. They're not, I really doubt that they're going to mix those two.
Okay.
I mean, if they give you a question that's a sales mix, they could then, with it, ask you for the margin of safety, and you would just have to find the break-even point, and then do whatever sales, the total sales of all the product divided by, minus the break-even point.
So if they have the company have like individual and the sales mix, they have two different questions, and they ask for the margin of safety. Like, what should we use
If they give you a sales mix question and then they ask you margin of safety, it would be for the whole company.
Okay.
Unless they tell you just for this product line. I mean, here's the thing, they can ask you anything, right?
Yeah.
And when you get into these CVP questions, you find that most often what they do is they'll give you information and then they'll ask you a number of applications. They'll ask you a break-even point, they'll ask you a target income, they'll ask you to make some changes and then recalculate the break-even point, they'll ask you for a margin of safety, they'll ask you for an operating leverage. Like, they'll give you like a mixed bag of things, and they might separate it into different examples, or it might all be for the same, with the same numbers.
But it must be in US in dollars, right?
For this, yeah, in dollars.
Okay. Thank you.
You?
No, I was stretching.
Oh, you were stretching. All right. There we go. Margin of safety. Last one, operating leverage. Oh, leverage. All right. Operating leverage is the one application where he sometimes asks you a theory question, so pay attention to the theory. So operating leverage is a measure of earnings volatility What does earnings volatility mean? I have my sales minus my variable cost, gives me my CM, minus my fixed cost, gives me my MI. If my sales increase by X percentage, how much will this change in sales affect my bottom line? This is asking about earnings volatility. If a change in my sales results in a big change in my net income, then that is high earnings volatility.
Okay, repeat that.
Hmm?
Did you say measure of what?
Earnings volatility. I missed an S here. Earnings volatility.
Could you just repeat what you just said about high earnings?
Yeah. Basically what it's saying is, if I have a change in my sales, what will be the ripple effect for my net income? Will it be a big ripple or will it be a little ripple? Because a change in my sales is going to cause a change in my net income. But the question is, will my change in sales result in a big change in my net income or a small change in my net income? It's going to change. If my sales go up, my net income has to go up. But how much will it go up? Will it go up by the same amount of percentage? Will it go up by 2 times the amount? By 3 times the amount? By 4 times the amount? If a change in sales results in a change in net income that is very amplified, then that's very volatile net earnings. If a change in sales results in a smaller ripple effect, then those earnings are more stable, right? So it's the relationship of change in sales to change in net income. It's like saying 2 people kick a ball, right? And one person kicks a ball and it goes 100 feet versus another person who kicks the ball and it goes 1,000 feet. Right? So it's the same action. The ball getting kicked, but how far does it go? So you might have 2 companies that have the exact same change in sales. Both companies, their sales go up by 5%. But a company with low operating leverage might see the resulting change in net income be only an increase in 10%, whereas a company with high operating leverage might see that result in an increase of 50%. It's just by how much multiplied? How much does the change create like an amplification? Right? And this depends on whether or not you have a high operating leverage or a low operating leverage. It depends on your cost structure. Right? So a company with high operating leverage, and this is really important, you know, you've got these two companies, and let's say both of them are in the same market, and the market fluctuates, right? The market's starting to boom, it goes up. The same increase in sales, for this company, their net income increases by 10%, so it's doing well. But this company, it increases by 50%. So if you were to compare them, one is doing good, and the other's like, well, boom, doing great, right? But operating leverage works in both directions. The elevator goes up, the elevator comes back down. If the market then goes down by 5%, well, this company, they'll go down, their net income will go down by 10% as well. But this company, boom, will go down by 50%. The sword cuts both ways, right? A high operating leverage company, their net income will fluctuate up and down and up and down very intensely. It's going to look very amplified, very big, very dramatic. Whereas a company with low operating leverage, as the market fluctuates, they will fluctuate less dramatically. Nothing to write home about, but more stable. Okay? So how do we calculate our operating leverage? Very simply, it's contribution margin over operating income. Operating income is net income before taxes. Okay, it's the same thing. So CM over my NI. Okay? So, if we have two companies, let's imagine that one, their operating leverage is 2.5, and the other one, their operating leverage is 6. And the operating leverage is going to come out a number like this. It's going to be a relatively small number. Because whatever comes out here, we call it your degree of operating leverage. And whereas all the other formulas we've done, we've either gotten a dollar or a unit or a percentage, this is none of those things. This is not a dollar, it's not a unit, it's not a percentage, it is a multiplier. It tells you, when you have a change in this, how much this is multiplied. So if I have company A with operating leverage of 2.5 and company B with operating leverage of 6, and both of them have a 15% drop in sales. What will be the resulting change in the net income for both of these companies? Very simply, you do the percentage change in sales, so 0.15, multiplied by the operating leverage, multiplied by 2.5. Someone plug that into their calculator?
0.375.
0.375. Which is equal to 37.5%. For company B, same thing, 0.15 multiplied by their operating leverage, which is 6, equals
90%.
0.9, which is equal to 90%. Both of these companies, their sales decreased by 15%. Both of them experienced the same fluctuation in sales. But company A's net income dropped by 37%, and company B's net income dropped by 90%. And it's because of the operating leverage. So if I'm talking about a company, and I'm giving you the operating leverage, and I ask you which one is more risky, which company is more risky, A or B? B. Higher operating leverage equals more risk. It's more volatile. You have a chance of making way more money, because if I had just said it was an increase, you're looking at these companies and being like, oh, B is a crap company. But what if I had said it was a 15% increase? Then you would have been like, B, I invested it, I was in at the ground floor, and I'm a millionaire now, right? Like, so it's like, it's neither good nor bad. It's just whether or not you want to take the chance. There was a question up at the top, or did I answer it when I just kept talking?
Well, it's just like the 37.5% is a decrease in income, right?
A decrease in your net income. This is the change in sales. This is your multiplier, so your operating leverage. And this is the resulting change in your net income.
Is it the resulting net income before tax?
This is the change in net income before tax, yeah. The only time that we really talk about tax is the target income before and after tax. That's the only time we kind of swivel that in on it. Oh no, it's the total. Yeah, you have to do it as a total. Because wherever it's at. Okay? Alright, so that's chapter 6. Chapter 5. So here's what I'm going to say about chapter 5. Chapter 5 is ABC, activity-based costing. Activity-based costing is essentially using your predetermined rate, except now there are multiple cost pools. Okay? So, let's talk about this here. The ABC question, honestly, it should be, for your long questions, your easiest one. The math is very simple. And in general, it's not complex work, it's just repetitive. So, going back to our predetermined rate for normal costing, right? Beginning of the year, we estimate our total overhead, we pick an activity base, we estimate the total activity base, that gives us the rate for the year. We use that rate throughout the year to apply our overhead. And at the end of the year, we come up with a problem where we have our total overhead incurred and our total overhead applied. And these two things will not be equal. And this is a problem for companies, right? Because the adjustment at the end of the year is tough on a company. It might be a situation where if you had underapplied your overhead, essentially what you've been doing all year is undercosting your units. If you're undercosting your units all year, then you might be underpricing your units all year. So at the end of the year, you find out that you have not been making the amount of money that you think you've been making. Right? That's a pretty crap situation. The other situation is that you've been over-applying your overhead, which means that you might be over-costing your units, which means you're not being competitive in the market. It means you're losing sales, it means that you're just going to get pushed out of the market because you're really not competing with everyone else properly, right? Not being able to get your overhead as in control as possible is a distinct business disadvantage, right? And your overhead, especially in modern manufacturing, is a very large portion of your costs, right? Think of it. Nowadays, we don't have that many workers in manufacturing. They're all replaced by machines, right? My DM and my DL, sure, they're not like something to laugh at, but my overhead is by far my largest cost for most manufacturing companies. Depreciation, utilities, my taxes, everything. Like, your manufacturing overhead is a huge amount of your expenses. And you are taking your best guess at applying them. Being off by a little bit is a big difference in your company. So it's really important for people to try to, as much as possible, bring that number as tight as possible. Get your applied overhead as close as possible to your overhead incurred, right? There's got to be a way to make that system more accurate. And it makes a big difference for companies. And ABC is one way that for some companies, you can make your overhead allocation more accurate. Okay? And here's why. When I calculate my rate, my estimated total overhead for the year, divided by my estimated total activity base for the year, gives me my rate, right? Let's look at the problems here. Number one, why am I dumping all these costs into one category? When you actually I said like overhead was that drawer at home where you open it and it's like there be dragons, like there's a whole bunch of things that don't make any sense together. Like every kitchen has this drawer, you know what I mean? Someone's like, oh, where are those little sticky things to put at the end of the corn cobs? And you're like, oh, it's in the crap drawer, along with like rolls of tape and like old cell phones and stuff. Like it's a really weird combination of things in that drawer. Why are you putting all those things together, right? And you're doing it out of convenience because you don't really have a place for those things. Why am I putting all these things together in this overhead category? Why am I saying that my indirect labor and my indirect materials, which I'm incurring kind of on a daily basis, is the same as my rent, which I'm incurring on a monthly basis, or my taxes, right, which come in yearly, or the same as, my inspection costs, which I might only incur like for every batch of things, or these are all really different costs that I'm incurring at very different rates and for very different reasons, right? The relationship of my rent to my units, or my inspection costs to my units, or my taxes, or my depreciation, these things have very different relationships to each other and to the units. It's a hot mess. And there's no reason to put them all in the same category other than simplicity, other than convenience. So that's one. The nature of these things is very different. And why do we only need to use one category? And then the activity base. The activity base that I use is generally direct labor or machine hours, right? We choose them because they have direct relationships with each and every single unit. They give a measure of how those units take more or less of our resources, right? But my activity base, that tends to be an activity that happens for every single unit. It's a unit level activity, right? So here, I have a group of things, some of which are unit level, some of which are for my whole company, some of which are just for some things, some of them are for the others. And I put them all in one group, and then I divide them by one activity base, which is a unit level activity. So I treat everything that's in this group as if it's a unit level activity, even though what's in here is all kinds of things. And I apply them all at exactly the same rate. And what ends up happening is the rate is an average of all these things, and it's applied to each and every unit on a unit level. And ABC says, what if? what if I break this into multiple pieces? What if I divide up what's in this group by what kind of activity is taking place? What if I identify that my activities can be unit level activities, but they can also be batch level, they can also be product level, or they can be facility level. Right? I have some things like, you know, like some of my kinds of indirect labor and indirect material, they're happening for every single unit, right? The sandpaper, which is indirect material, I use it for every single unit. So that manufacturing overhead cost, that's a unit level manufacturing overhead cost. Then I might have batch level things that are happening, like when you brew beer, right? You brew it in batches, in huge vats. And you know, they put a massive amount of beer in a batch and in a vat, and it ferments, and then they empty it and they bottle it. So if you drink a bottle of beer, you can actually trace it back to what batch it came from, so that if there's a problem, you know. But between each batch, they clean the tanks, right? So that activity, it doesn't happen for every single bottle. It happens for every batch, because it only happens once for each batch that you make. You could also have product level activities. So things like research and development, or designing a new product, or redesigning a product, engineering that product, testing that product, right? That happens only once per product line. Or it happens at a product line level. I have to recuperate those costs 1 unit at a time, but I incur those costs for the entire product line. And then I have facility level type costs. This is rent, depreciation, right? Utilities, insurance. These are costs that I incur to support my entire production facility. So ABC says, go through these costs and bust them out based on the level that they're at. And instead of one big pool and one rate, make multiple pools. For each and every single pool, right? So for each and every single cost pool, figure out a cost driver for it. Cost driver is the activity base. When we use normal costing, we use the terminology activity base. And when we use ABC, we use the terminology cost driver. So each and every single pool has its own cost driver. And now, instead of applying your overhead to each unit in one shot, you say, this unit took 20 hours, and my rate is $5 per hour. That's $100 of manufacturing overhead that I'm going to apply to this unit. Instead, you're going to apply it in pieces. You might have 5 different cost pools, and they each have 5 different drivers. And you do your overhead in pieces. Et cetera, and you add it all up to the total manufacturing overhead applied. So instead of applying it in one shot, you apply it 1 pool at a time. And it adds up to a total. And by doing it in these little pieces, you can increase your accuracy. Right? Because you might say, for this pool, this unit took up a lot of these costs. And then for this pool, it took up less. And for this pool, it took up more. And that pool took up less. And the next unit might have a different combination of uses of the different MOH. It's like digging in and being more accurate with the pieces. Right? I like to relate it to if you had two stores and one store basically sold everything in one size fits all. You went in and everything was one size fits all, or you went into a store and they had sizes 0 through 20, right? Like, if you fit that one dress size, great for you. And for the other 99% of us, we like this store better, right? This one has, it can respond better to the particularities of every little complex thing that's going on up here. Now, that being said, ABC is not for every company, right? ABC does have its downfalls, because whenever I describe this, people are like, why do we even ever bother with this if this is so much better? And the reason is that this is really expensive, right? In this one, it is so easy. One pool, one rate, one number. This is less work of bookkeeping, less accountancy work, but you're not really keeping track of much, right? Your activity base is direct labor hours, which you're keeping track of anyway. So this is super cheap and easy. Whereas here, you have 20 different cost pools, which means you have 20 different cost drivers that you now have to put in systems for keeping track of them to know how much each unit is using. You have to have a whole new accounting system, and it takes so much longer to calculate and figure out. So this is much more expensive. So the question is the amount of accuracy, right, the improved control that you gain from using ABC worth the extra cost for your company? And for some companies, they will answer yes, and they will use ABC. And for some companies, the answer is no, and they will continue using normal. And there's some general indications of what kind of companies will choose ABC over normal. If your company makes one kind of product, and that's it. Your company makes wire hangers, and that's it. They make wire hangers day in and day out. That's all they make, that's all they sell. Then ABC will do nothing for that company. There is no point, because every single unit you make is exactly the same as the last, right? They're all exactly the same thing. So why do you need all these multiple rates? Just do this. But if your company has multiple, and these are the kind of the indicators that ABC will work for you, if you have multiple product lines, and those products are very different from each other, consuming different resources at different rates, then ABC will be great for you, right? You make, like a bargain basement, little ghetto blaster radio that you sell for $20. But you also make a hi-fi deluxe stereo system that sells for $5,000 a piece. And you make a bunch of ranges in between. Then ABC will be great for you to figure out the very different particularities of each of these product lines. Okay? So that's it for the theory, guys. That's chapters 1 through 6. So what I can tell you for tomorrow is please come with all of the past exams that you have available, downloaded from Moodle. Go and get other available exams, okay? You can find them shared on Passage MSD. Come with all those different exams, either printed out or available on a laptop or something that you can really see. I always see every time some poor soul with a tiny little cell phone trying to do the problems on a tiny little cell phone, and it's a nightmare for them. So bring a computer or a tablet or print them out. Huh? The past midterms. There's on Moodle, and there's also more that you can get off of Casa JMSP's Facebook. Come ready to work. Come with scrap paper and calculators, and we're gonna work it together, and it's gonna be long and it's gonna be late, so bring snacks and a good attitude. We'll see you tomorrow.